Hello friends, welcome back to this session. In today's session, we are going to learn how to value the stock on consignment business. So guys, we are going to do valuation of stock in this case where I have already written the example. Now, from the example, we will see how to value the stock in the consignment business. So starting with the example, Central Oil consigned 1000 barrels of oil costing 800 per barrel to Lubrisols Limited. Central Oil paid 50,000 as freight and insurance. 25 barrels were destroyed in transit. Lubrisols Limited took the delivery and paid 11 to 50 as carriage to godown, 10,000 as godown rent and 20,000 for selling expenses. 40 barrels were again destroyed by fire in the godown. Lubrisols Limited sold 750 barrels at 1200 per barrel. 25 barrels were lost due to leakage, which is considered as normal loss. Calculate the amount of closing stock. So over here, we are not required to pass any journal entries or ledger. They have just asked you to find out the closing stock. Now this would be one of the adjustment in the entire questions. So this is like a question which comes in your consignment where consigner, now Central Oil consigned 1000 barrels. So Central Oil is consigner and it is consigned to whom? Lubrisols Limited. So Lubrisols Limited is a consignee. So as we have seen in the previous session that this is the normal business, normal cycle where consigner sends goods to consignee, consigner pays expenses. In between, in transit, there can be abnormal loss which is not predicted. Then consignee takes the delivery of the goods, consignee pay expenses, consignee sell those goods. It might be possible that if the goods are in the godown, there might be any loss, abnormal loss. Then there are 25 barrels which were lost due leakage and which is considered as normal loss. This we have already discussed what is normal loss. So this is the normal case, and if you see, just 1000 barrels were sent and there are some abnormal losses, there is some normal loss, there are some barrels which are sold, and finally you need to find out how much is the closing stock. So you need to find out the value of the closing stock. So starting with it. Now first of all, when we do closing stock, we generally see what is the cost or net realizable value, whichever is lower. This we do in normally our final accounts question where we see cost or market value, whichever is lower. So in the case of closing stock valuation also we see cost. Actually the term which is normally used is market value, but the actual term as per accounting standard 2 is net realizable value. So we see cost or net realizable value, whichever is lower. Now net realizable value is the market value. Now market value is not given in this question, so we are just going to do the cost of closing stock. So we are not considering the market value over here. Now next, when we see the valuation of stock, we take the purchase cost plus we add all the direct expenses incurred to purchase those stock, purchase those goods to make them saleable. So we are going to add those expenses in the purchase cost. Starting with the first purchase cost, we will prepare two columns for quantity and amount. Now, Central Oil consigned 1000 barrels of oil costing 800 per barrel to Lubrisols Limited. So first of all, we'll say goods sent on consignment. So goods sent on consignment, how much quantity it is sent? 1000 barrels are sent. So 1000 barrels are sent at rupees 800 per barrel. So this would be 1000 into 800, that would be 8 lakhs. So amount is 8 lakhs. Now for sending this quantity or sending this barrels of oil, Central Oil paid 50,000 as freight and insurance. Now when you do valuation of closing stock, you have to add all those expenses which are incurred till the goods reaches to the godown of the consignee. Okay, after doing this example, we'll see the notes for the same, but you just remember you have to add all the expenses incurred till the goods reaches to the godown of whom? Godown of consignee. So these are all the direct expenses till the goods reaches to the godown from where it can be sold. So you need to add purchase cost plus all the direct expenses incurred to make those purchases. So now we will also add consignors expenses. So now consignors all expenses incurred to send the goods to the consignee should be added. So I will say add consignors all expenses. So in this case quantity would be 0 and consignor has incurred how much expense? 50,000 as freight and insurance. So that 50,000 is added. So now 1000 quantity of goods are worth of 8,50,000. So if you see, this 50,000 is an important expense because if consignor does not incur this 50,000 rupees, then this goods cannot reach to the godown of the consignee. So this expense of 50,000 is incurred to make that purchase or is incurred to send this consignment to the consignee. So this should be added. So you remember you have to add consignors all expenses. All expenses of consignor should be added. Now when these goods were going, now these goods are now 1000 barrels are worth of 8,50,000. 8 lakh was the purchase cost. 50,000 is your direct expenses for these purchases. Now when these goods were in transit, there were 25 barrels were destroyed in transit. So now consignee will receive only 975 barrels of oil because 25 barrels are already destroyed in transit. So you need to deduct that abnormal loss. So less abnormal loss. Abnormal loss quantity is 25. And what will be the value of 25 barrels? So that you need to find out. So in this case we are going to do cross multiplication. Now when I say 1000 barrels are of 8,50,000, 25 barrels would be how much? So you will just cross multiply. So 25 into 8,50,000 divided by 1000. So that comes to 21,250. So now we will say 975 barrels of oil are worth of 8,50,000 minus 21,250, 828,750. So guys, you understood this? We have deducted this abnormal loss because consignee has received only 975 barrels and those 975 barrels are worth of 828,750. Now when we have done the journal entries, we have also discussed for this abnormal loss. This loss we will account. This would be credited in consignment account for 21,250. If you have received any claim for this 21,250, that would be deducted. And if you have not received any claim, then this entire 21,250 is your loss which will be transferred to P&L account. Okay. So now 975 units quantity are worth of 828,750. Now what Lubrisols had done? Lubrisols Limited took the delivery and paid 11,250 as carriage to godown, 10,000 as godown rent and selling expenses. Now again on these goods, consignee has incurred expenses, so we will add those expenses. Add consignee's non-recurring expenses. Now this is important. What I told you in the beginning, you have to add all those expenses till the goods reaches to the godown because that are the purchase cost to make the goods reachable till the godown. So that are all the direct expenses. Now you again consignors all expenses are all the expenses which are incurred till the goods reaches to the consignee. But if you see consignee's expenses, you have to just take non-recurring expenses. Now non-recurring expenses means all those expenses incurred till the goods reaches to the godown of the consignee. So if you see over here, 11,250 is paid as carriage to godown, so that would be added. 10,000 is a godown rent. Now this will not be added to non-recurring expenses because this rent would be incurred once the goods reaches to the godown. So this is the godown rent. So we will not add these expense. And 20,000 is selling expense. Again, this is not a direct expense for the purchaser. So selling expense are not added. So only those expenses till it reaches to the godown. 10,000 godown rent is after the goods are reached to the godown. Once your goods reaches to the godown, then you pay the godown rent. Okay. So you will take only 11,250. Again, quantity would be 0 because there is no increase or decrease in quantity. Only the cost is increasing by 11,250. So now check. 975 quantity are worth of 828,750 plus 11,250. So that comes to 8,40,000. So you understood this? Now after this, there were 40 barrels again which were destroyed by fire in the godown. There was a fire in the godown of consignee and 40 barrels were lost. Again, loss by fire is a normal loss or abnormal loss? Yes, it is your abnormal loss because it is unpredicted. So again you will deduct those 40 barrels. So less loss by fire. Now again this is my abnormal loss. How many barrels? 40. What would be the cost of this barrel? So again cross multiply. 975 is worth of 8,40,000. Then 40 barrels would be how much? So check. 8,40,000 into 40 divided by 975. So that comes to 34,462. We will round off. So 34,462. That is the loss value, abnormal loss value. So goods worth of 34,462 are lost by fire in the godown of consignee. So now we are left with 975 minus 40, 935 quantity and 8,40,000 minus 34,462, 805,538. So now we can say 935 worth of quantity are worth of 8,05,538. Okay, so guys, you understood this. Now this abnormal loss was deducted before adding the consignee's expenses, because once consignor has sent the goods, consignor has incurred the expenses. In transit, these goods were lost. So consignee has not incurred any expense on this 25 barrels. That is why first of all we deducted that abnormal loss, and then when the goods are received by consignee, then consignee has incurred those expenses of 11,250 for the carriage to go down, and then again 40 barrels were lost. Now you do not deduct 40 barrels with this abnormal loss, because on this 40 barrels consignee has already incurred the carriage expenses, because these goods have reached to the godown and then there was a fire in the godown. Okay, so we are going step by step. At what stage what happened, that first the goods were sent, then consignor incurred expenses, then some goods were lost, then consignee also incurred some expenses, then again some goods were lost, and these are the remaining goods. Now finally Lubrizol sold 750 barrels at 1,200 per barrel, so sales will take at the last. There were again 25 barrels which was lost due to leakage, which is considered as normal loss. Now after doing this, do I have 935 quantity on my hand? No, we have only 935 minus this 25 normal loss, that much quantity on hand. So again we will deduct less normal loss of 25 barrels, because these barrels were already lost due to leakage, and these quantity we have never ever received. So consignee has never received. So that is why consignee has received only 910 barrels of goods. So guys, you understood this? Now normal loss, for normal loss we never account in our books of account. It is directly adjusted from the quantity of the goods, and we do not find out any amount for the normal loss because it is directly adjusted. So if you see previously, if you see this, we say 935 quantity are worth of 8,05,538, but now 910 quantity are worth of 8,05,538. So quantity has decreased, so cost per unit have increased. When you decrease the quantity, your cost per unit would obviously increase. Okay, so normal loss is directly adjusted in the quantity, but you will not find any amount, it will not recorded in your book. So guys, this is very important. You just deduct the quantity of the normal loss. This also we have discussed while we have discussed the journal entries. So normal loss, we just deduct the quantity, but we do not find out any amount for the normal loss. So you understood this, and then this 910 quantity we say as value of good quality stock. So these are the stock which are in good conditions, received by the consignee, can be sold by the consignee, but out of which consignee sold how much? 750 barrels. So if I say my closing stock would be, finally consignee has 910 barrels, minus 750 barrels were sold. So 910 minus 750. So that comes to 160 barrels. Now you find out 910 barrels are worth of 805,538. Then 160 barrels would be for how much? So you find out this. Cross multiply 160 into 805,538 divided by 910. So this comes to 141,633. This is your value of closing stock. So guys, you understood this value of closing stock. So over here, what we are doing, we are just finding, first of all, we are finding what is the value of good quality stock. Good quality is after adding all the expenses, direct expenses, non-recurring expenses of consignee. We are deducting all the losses, normal, abnormal losses. No, abnormal loss, we find out the amount because we pass the journal entry for the same. But normal loss, we never account in our books of account. It is directly just adjusted in the quantity. You find out good quality stock, value of good quality stock, that you compare with the closing stock. Directly, we cannot find out closing stock. So, we find total goods, this much is the cost. So, closing stock, how much would be the cost? That is the comparative basis we are doing in the valuation of the closing stock. So, these are the total goods. This is the total cost of the goods. This is my closing stock. What would be the value or the cost of this goods? Now, this element is your cost element. If they give you market value of the goods, you also find out the market value, and cost or market value, whichever is lower, will be value of your closing stock. But in this question, they have not specified any market value. So we assume closing stock would be valued at cost itself. So this I can say as my final answer, value of closing stock. That is 141,633. So guys, you understood this. So this is your normal format of closing stock working. Goods sent on consignment, consignor's expenses, less abnormal loss if any, add consignee's non-recurring expenses, less again abnormal loss if any. Ultimately, when you find out the balance of the goods, you deduct normal loss only quantity and not the amount, value of good quality stock, that you compare with the closing stock. So you see, it's not that difficult to calculate the value of stock. So now let's see in the notes for the same. This is the same format that we discussed in our example. Same, just I have written the format for your notes purpose. First of all, cost, goods sent on consignment. Now first we say goods sent on consignment, we take the quantity and the amount. Add consignor's all expenses. Always remember that you have to take all the expenses of the consignor, because those all expenses are till the goods reaches to the go down. So take all the expenses of the consignor. So consignor's expenses could be carriage, freight, insurance, packing charges, etc. Less abnormal loss if any in transit. So in transit, if there is any abnormal loss, they must give you the quantity and you find out the amount by cross multiplication. You deduct that amount, you deduct the quantity. Then you add consignee's non-recurring expenses. Now what are the non-recurring expenses that I have written over here? Consignee's non-recurring expenses till the goods reaches to the consignee's go down. So that would be carriage up to go down, freight up to go down, custom duties, octroi, clearing charges, dock charges, unloading charges that go down, etc. So these all expenses till goods have not yet reached to the go down. So till goods reaches to the go down. Next, abnormal loss if any. Again, if there is any abnormal loss once the goods have reached to the consignee's go down, so that you deduct the amount. So guys, if you see, if there is expenses, don't take the quantity. Quantity would be 0 because in expenses, your quantity are not affected. But if there is abnormal loss, you have quantity, you cross multiply, you find out the loss amount. So this much quantity are worth of this cost, then abnormal loss quantity will be worth of this much cost. You deduct that quantity, you will find out the balance. Now if there is again normal loss, you just deduct the quantity and not the amount. This is important. In normal loss, you will just deduct the quantity, you do not deduct the amount. We do not pass any entry for normal loss in our accounts. We just adjust our quantity in your total stock. So value of good quality stock, finally this is the good quality stock for this much value. So closing stock, how will you find out closing stock? good quality stock minus all those units which are sold. So this much is your closing stock. What would be the value of closing stock? Now this is your cost. We have already discussed this consignor's expenses, consignee's non-recurring expenses. You remember what all expenses you are not included. So following expenses are not included in this valuation. So that is all those expenses once the goods have reached to the consignee's godown. So that is godown rent, warehouse charges, discount, bad debts, insurance of goods in godown, office and administrative expenses, selling and distribution expenses. So all your admin and selling expenses will not be added because those are not your purchases direct cost or purchases direct expenses. Okay, so you take only those expenses, all the expenses of consignor and non-recurring expenses of consignee. Then this is the cost element, but what we have said, valuation of cost is cost or net realizable value, whichever is lower. So this is your cost that we denote with A. Now NRV, net realizable value. Net realizable value means what amount you will get once you sell the goods in the market. So this is your closing stock at market price. This closing stock quantity will be found from here. Over here you have already found out the closing stock quantity. So you take that quantity, you multiply with the market price. So this is your market price of the quantity. Now you deduct commission from this. Guys, this is very important. When we say net realizable value, you have to see how much you will realize in hand after selling those goods. So when I say closing stock at market price, this is the price which I will receive from the market. But these goods are sold by whom? By consignee. So by default, consignee is going to deduct his commission from this market value or market price, or you can say sale proceeds. So that is an expense which is going to happen, and on hand you are going to realize only this much value after deducting the commission. So you always remember then when you want to find out NRV. That is why previously I told you, generally in normal accounts we say as cost or market value, whichever is lower, but technically it is cost or net realizable value, whichever is lower. So net realizable value is market value minus those expenses which are going to be incurred and whatever amount you are going to receive on hand, that is your net realizable value. So this is your cost, this is your net realizable value. Now you just deduct the commission because this is the for sure expense which is going to happen. Now all the selling expenses like advertising and all, that is not predicted, that is not compulsory. So you just deduct the commission that is going to happen to sell these goods at the location of the consignee. So you deduct that commission and this is your NRV. And this is your A or B. Your closing stock would be cost, that is your A, or net realizable value B, whichever would be lower. So that I have repeated over here, cost or NRV, whichever is lower. So guys, you understood this. NRV you have to do only if it is specified in the question. So if they don't specify, what they will specify? They will specify the market price. So if they have specified the market price of the closing quantity, or at the period end or accounting period end or the year end, the market price of the goods are this much, then you do the NRV. If they don't specify market price, then you will just do the cost that we have done in the example, where there was no market price and we just find out the cost of the closing stock, and that we will account in our books of accounts. So guys, you understood this valuation of stock, cost or NRV, whichever is lower. Cost, goods sent on consignment, that is your purchase cost. Add consignor's all expenses, add consignee's non-recurring expenses, and that is your value of good quality. Now in between, if there is abnormal loss, you deduct. If there is normal loss, finally you just deduct the quantity, and good quality you compare with the closing stock. So I hope you understood this valuation of stock that will come almost in every question. So this would be one of the working notes in your sums. So that's it friends. Hope you have enjoyed learning with Letstute Accountancy. In the upcoming session, we will be learning valuation of goods in transit. So stay tuned with us. Thank you.